everybody, it's Jim from G2H Companies. I made a post on Reddit not too long ago that got a bunch of likes and comments, and it was Ask Me Anything multifamily investing and underwriting. And I wanted to jump on and answer some of the questions. And, I figured it'd be good to make a little bit of a video kind of describing, or I figured it would be good to make a video kind of answering some of these questions. I'm just going to do a couple today. So the first question that I got was it common for you to be working 6 to 7 days a week in your first couple years in the business? How many years did it take for you to be making 200K plus? What helped you scale from selling 5 to 20 unit properties to selling 100 to 200 unit properties? What cap rates are you currently seeing trade? And do you underwrite with windstorm insurance included? So I'm local here in Florida. That was another big question that came up. I didn't really think it was super important for this video, but obviously all the insurance, hurricane insurance, wind, all that insurance, huge question here in Florida. But to start, was it common for you to be working 6 to 7 days a week in your first couple of years in the business? So I guess for number one, very simple, right? So the answer is yes. It was very common for me to be working all the time. My motto actually is life is work. So I only do stuff that I really enjoy doing, and I pretty much do it all the time. So I work Monday to Sunday. I don't know necessarily that you have to, especially if you're going into, commercial real estate, because, commercial real estate is a lot more kind of business to business and not so much business to person. So a lot of the stuff that I was doing was me to an investment committee or me to a group of investors or a syndicator. And it's a lot more of in a business environment. And those guys, they don't really work Saturday, Sunday. They're like Monday to Friday, 9 to 5 type of guys, or maybe, 9 to 7. And sure, they'll tell you they work a million hours, but like whatever, right? So at the beginning, when you're just getting started, I would expect to work like pretty commonly. I think something to take into consideration is like, if you're selling real estate and people are buying real estate, that means they have to have jobs, and they're probably at their job like, 9 to 5, Monday to Friday when you want to be working. And so you need to kind of be available outside of those hours so they can push business forward. And I don't know that that's something that you'll have to do forever, but definitely I would expect to work pretty regularly your first couple of years and just start to build that book of business. But it's not like clocking into a job. Nobody's really checking on you. You have a lot of freedom and a lot of super flexible environment, right? It's not like a clock in, clock out thing. So working 6 to 7 days a week might not be as big of a deal as it seems. So number two, right? So how long did it take me to make 200 grand a year? I think I was pretty lucky to start. I would say the typical path for people is your first year, if you're in commercial real estate, right? So let's say you're selling deals that are like $2 to $10 million. I would say your first year, you'd be lucky to make like 40 grand. Realistically, you'll probably make like $12,000 or $15,000. And most of that's going to come from a draw, right? Which is your company essentially fronting you some money that you're going to have to pay back. And so that is going to come out of your first check. And the draw doesn't last forever. So if you don't start closing deals, they're going to stop paying you. And a lot of places don't even have a draw. So your first year, let's call it 12K to 15K, right? Not going to be a ton of money, but you're going to be starting to establish yourself in the industry. I think you get to year 2, you'll probably have like one closing, maybe 1.5. You'll probably make 45K. And then in year 3, this is where I start to see people really break out. And so in year 3, I think people can make 100K to 180K. Keep in mind, like there's like, if you join with 150 agents, maybe one guy or gal will make 180K. Their third year. A lot of people will be sitting probably 90 to 120. You're getting a good book of business. But then as you go, years 3 to year 5, you could pretty easily make 300K to 500K. But you got to understand, most people don't make it here, right? Most people quit year 2, right? Because all in, like let's say you're at the end of year 2, you've made effectively $57,000. You're like, this sucks, right? And I think a lot of people just kind of give up there and they never make it to this section here where they're actually starting to make some money. And, the team that I was on made, much more than 300 grand a year. So the upside is really massive. So what helped you scale from selling 5 to 20 unit properties to selling 100 to 200 unit properties? So I think for that, and people aren't going to want to hear this, but I'm just going to be honest. Everybody on the internet lies like crazy. I'm going to say connections. Listen, I mean, when you get up to these huge deals, right, a couple hundred units, and like the sale price on the biggest deal that I ever did was $300 million. Like, you're not really going to prospect that business. You deal with people like Blackstone and BlackRock, Bridge and True America and all of these companies that have existing relationships in the market. They know brokers. They've been dealing with these guys for years and years and years, and these guys have a huge track record of execution. So how I jumped from working on smaller properties to bigger properties was essentially taking a year and working for free. I was an intern. I had moved down to Florida from Chicagoland. Really just grit. To be honest, they didn't really want to hire me at the beginning. I didn't have any qualifications. I didn't go to college. I didn't have any connections like in Florida. I know I wrote connections down, but so it really, you just gotta kind of get with the right people and get with the right team, or add a tremendous amount of value and come to these institutional guys with a new way of making money, and then they'll listen to you. But I mean, if you're just trying to say like, hey Jim, how do I sign up for real estate today and start selling a 300 unit apartment building? Like, either your dad owns one, or you're probably not going to do it. Like, you got to build up to that. Like, you can't start. That's like putting your son in the MLB to start without having to go through any of the other leagues of baseball. But anyway, so what cap rates are you currently seeing trade? True cap rates with at least 40% plus expense ratio. At a super duper high level, I think a minimum expense ratio should be 43%. And that's like if you have 200 plus unit and good management. So what cap rates are we seeing trade in the market? So the cap rate is always in this market. I mean, it depends kind of, I suppose, on what market you're talking about. So there's a residential market, then there's a small commercial market, a mid-sized commercial market, and a large commercial market. I would say as you go up the tier, the pricing is more immediately impacted by interest rate. So the farther you go up the ladder, the quicker the pricing adapts. And there is no set in stone cap rate. I mean, it is hyper deal specific, product type specific, location specific, buyer specific. I used to get this question all the time from tons and tons of different people. And the truth is, there is one way to get a cap rate, but there are a million different ways to get the numbers you plug into the cap rate equation. It's so simple, it lends to a lot of flexibility. I really have always hated talking cap rates because, like, you'll say a cap rate number and then somebody like, well, I'm looking at the T3 over the T12 with readjusted this and I put in my insurance numbers, and it's like, well, that's not really the cap rate, is it? No, that's your made up cap rate. So I would say true in place, people are like 50 bip over debt. So wherever the debt is currently at, I would try to price like 50 bips above that. I think I've heard that from a ton of people in the industry over the years. That's a big target. A couple years ago, people were okay with negative leverage. They're not okay with negative leverage anymore. So number one, was it common to be working 6 to 7 days a week? Yeah, I work all the time. I would expect to work all the time and do something that you're happy with doing all the time, especially like real estate's your own business. Really, you're starting your own little shop. And so just expect to be available. And at least for the first couple of years. How many years did it take you to be making 200K plus? Again, I'm a little bit of an anomaly. I would expect for it to take probably 3 years before you really hit the 200K number and can do it like repeatedly, right? What helped you scale from selling 5 to 20 unit properties to 100 to 200 units? You got to make connections. You got to prove yourself. And sometimes you're going to have to work for free a little bit. And that's just kind of what it takes. What cap rates are you currently seeing trade? Again, 50 basis points over your debt is probably where you would be at. Oh, and here you go. How do you underwrite with windstorm insurance included? I just underwrite with an insurance assumption. I got a guy from Brown & Brown. I call him. I give him the property address. He gives me a rough estimate. That's what I plug in. People want to talk about insurance a lot. It's really not that complicated. You just talk to your insurance broker, plug in your numbers. It's going to be what it is, right? So question number 2 here. When you're underwriting a deal, how do you know what's a good deal? At a quick glance, do you usually use a combination of target IRR or equity multiple to determine strength of the investment? Additionally, any tips you may have regarding the presentation of an investment opportunity or capital raising opportunity to investment committee? So this is a great question. So I guess that I don't have a great answer. I think I've been doing this for a long time, and a lot of it's just on gut feel, location. I see the asset, I walk the property, I talk to the manager. ask about rents and collections and vacancy and amenity requests and just kind of get a feel for what's going on site. And then I can kind of eyeball whether or not I think it's going to be a good deal. I think a couple things to be weary of when you're looking at a deal for the first time is the property clean? When you drive around, is like garbage around? Does it look like it's actively managed? When you're there in the middle of the day, are there a bunch of cars there in the middle of the day? Or is everybody going to work during the day? This is not as great of an indicator as it used to be. I mean, really, until a couple of years ago, work from home was just not really a thing. So that was a pretty good indicator. Now, a little bit less so of an indicator to see, are people getting up? Are they going to work? Are they active? Are they doing things? And again, another silly thing, like on the weekends, are people just kind of staying in their house? Are they out traveling, enjoying the day, doing whatever? And again, those are kind of smaller things. I think the property being clean, actively maintained, that's important. Are people paying their rent? And, are the rents seem to be in line with the market, or are they below the market? If they're below the market, you probably got a little bit of an opportunity. But I think when I'm underwriting a deal in a quick pass, I just kind of feel the deal out. Would it be somewhere that I would want to live? I would want my kids to live? Or, is this somewhere that I think is actively maintained, if it looks like they're taking care of it? Because, the truth is, if there are people on site and it's actively maintained, housing is a really resilient market and you'll probably be fine. Now, if you're asking me how you find a home run at a quick glance, you really can't. You got to look at a million of them. And now for a full underwriting, I really just want to know, like, how much cash am I going to collect? How much cash should I put in and how much cash am I going to collect? I think that like if you're going out to raise money for an investment committee, or if you're a syndicator, people are going to focus a lot on your internal rate of your return. People are going to focus a lot on your internal rate of return and metrics like that, which are like a little bit more fugazi, I think, because when you're forecasting that out to get like your internal rate of return over 10 years, that means you need to make 10 years worth of assumptions that are correct. And all those cash flows are counted, and small differences in assumptions can make big impacts on value. And you've got to assume an exit cap rate and an exit sale price. And there's like a lot of unknowns associated with those type of return metrics, which is why, to be honest, I don't place a ton of value on them. They're absolutely essential. If you're trying to go get money from a bank or an investor, you're going to have to show them. But just so you know, as an investor, really the most important thing to me is like cash on cash. So like, how much money did I put in the deal? And how much money am I going to be collecting every year? Any additional tips you have regarding the presentation? Make it clean, make it consistent, make it standardized. Do not just print out PDFs with no formatting and just kind of like you're going to want to take the T12 and you're going to want to process it down into a standardized set of line items. And then you're going to want to do that for a bunch of different properties. And within the materials, you're going to want to compare your target investment property to other properties that you've invested in the area, and spend a lot of time focusing on the story. Everybody talks about the numbers. And the truth is, with the numbers in real estate, a lot of them, like I said, are kind of fugazi. So you need to have the right things and show the right things, have it formatted the right way so people don't ask a ton of questions, and you can bypass a lot of that stuff and just get to the story of the location, because that's really what real estate is about, the asset and the location, and why you think that there's upside there that somebody else isn't seeing. It's not really so much in the numbers, because once you get up to like a 50, 80, 100 unit apartment building, if it's professionally managed and somebody's taking care of it, really it is going to be, it's going to perform pretty similar to other properties. I mean, assuming again, there's no like crazy differences. And so I guess to make a couple notes, when you're underwriting a deal, I look, just how much cash does it take to get in? And then how much do I get out? And that's really it. It's just not that complicated. I think real estate is kind of a people business, a location business. You got to get boots in the ground. You got to see the asset. You got to understand the location. So I just wanted to come through and answer a couple of those questions. I hope you guys found that helpful. Again, I'm Jim from G2H Companies. If you guys have any questions about underwriting or anything like that, let us know. We have a ton of stuff up on our website. We've got an underwriting model and a bunch of different stuff. So there's some links below to our actual website and a whole kind of learn course on multifamily underwriting if you guys are interested. So thanks a lot. Really appreciate it. See ya.